Shall we go for it? Can we start? Okay. Good morning. Welcome, everyone. Thank you for joining this session. It's good morning for some of you, good afternoon or good evening for others. Thank you for being here. Let me kick off by saying that there is probably one thing that everyone around this call would agree on, that technology is changing the way financial services are produced and delivered. And we would also probably agree that this comes with opportunities and risks. However, beyond that overarching statement, when we try to explain what's going on in markets, the story gets complicated and it's hard to align to a single story. It seems like there's multiple plots that are evolving in parallel and are difficult to connect. We talk about platforms, we talk about embedded finance, the disruptive effect of fintechs, digital banks, mobile money, and so on. And all of these seem like parallel, divergent stories that are hard to bring together. In this morning's session, we will talk about the underlying changes that are happening in the financial services value chain that lead to all these different developments, and how this is leading to a market structure that has different dynamics than what we used to see in the traditional banking sector. It's a perspective that we think it's going to help us understand how these different stories connect. We will also describe how this makes a more suitable environment for financial inclusion. We have with us today an outstanding panel of executives who are very well placed to speak to that change from different vantage points. We have Philip Chu, who is the Managing Director of Grab Financial Group, the financial services arm of Grab, which is the leading super app in Southeast Asia. We also have Laura Crow, who leads product innovation at M-Pesa Africa, the original and one of the largest mobile money providers in the world. We have Puneet Gupta, who is co-founder and director of Kaleidofin in India, one of the most exciting fintechs in that market. And we have Margarita Henao, who is CEO of DaviPlata in Colombia, one of the most important mobile wallet and digital banking players in Latin America. My colleague Peter Zetterli will start by presenting the outcome of our research, and we will follow from there with a short moderated discussion with our four panelists. We will leave then 10 minutes at the end for questions from the audience. As we go along, please feel free to write your questions in the chat box, as we will take questions from there when we get to Q&A. I now hand it over to Peter. Peter, floor is yours.
Thank you, Javier, and good morning, good afternoon, good evening, everyone. As Javier already mentioned, the background for this conversation is the sense that banking is being disrupted, just like multiple other industries have already been, by technology and business model innovation. And the way we see it, that is playing out at three levels. At the level of banking products, the level of banking processes, and at the structure of the financial market itself. So at the level of banking products, every aspect of what a bank does today and offers consumers is being challenged by a whole host of fintechs trying to do it better. You look at payments, savings, lending, insurance, investing. In any aspect of banking, there are now dozens of players offering consumers what they think are better products. And what that proliferation of product fintechs does is let consumers pick and choose between products of different providers and assemble their own sort of personal Swiss Army knife of financial solutions that are customized to their particular needs and preferences. And that's good for consumers in several ways. It creates more consumer choice, greater value, especially for more marginal groups, perhaps, that aren't well served by generic products. And it's also driving sharper competition between providers at the product level. The exact same thing is happening on the process level, but it looks different and has a little different implications. So if we map out a stylized picture of the banking value chain, in the old days, banks largely did all of these things by themselves in-house. But today, we're seeing a similar proliferation of B2B fintechs, highly specialized on the back end, that are creating best-in-class solutions for every piece of the value chain. And they then pursue scale within that niche across large numbers of financial service providers, which creates economies of scale, which deepens their effectiveness around that piece of the value chain, and results in lower cost and higher value in the end-to-end chain. And what that means is that banking itself is being disassembled into its constituent parts, where financial service providers are increasingly able to swap out the old gritty pieces with new shiny fintech ones provided by third parties. And that's making financial value chains in financial services more modular, meaning that where back-end processes used to consist of fairly rigid hardwired rails built or at least owned fully in-house, they increasingly consist of much more flexible systems of modules that can be arranged and rearranged in different ways for different purposes, even on the fly in real-time processes. These are often provided by third parties, plugged in seamlessly through APIs, and paid for through software as a service models, meaning you pay per use. This is a very different way of manufacturing banking products, and it's not hard to see the potential efficiency gains in terms of better solutions, lower cost, greater flexibility. It also, of course, raises some pretty potent new questions, not least for financial regulators and supervisors. But what is perhaps the biggest revolution here is that it's not just banks that can do this. Any company that can plug in financial products or processes into their existing digital offering. And that's enabling what is often called embedded financial services. We think embedded financial services are a big deal for financial inclusion. It's a fundamental change to how banking works that can bring it closer to people. And that brings us to the third way in which financial services are being unbundled, the structure of the financial sector. We think this is all landing in a market structure that is itself more modular, organized around four broad layers. The balance sheet layer with a regulated balance sheet, risk management, and the licensing, the product layer, the customer relationship layer, and the physical distribution layer. Offering banking used to mean building all of these things yourself within the company, but new technology, new business models are enabling the separation and specialization across those layers, and economic pressures are then pushing in that direction, because different players have different strengths across these layers. And this unbundling into layers lets them make different business model choices across each of the four layers. And that's leading to the emergence of entirely new business models in financial services. And we have some excellent examples of that with us in the room today. So let's take Kaleidofin. They are a fintech company focused on using tech to serve unbanked, low-income customers, in particular women. In our analysis, Kaleidofin sits squarely at the product layer. They use a combination of deep customer understanding and sophisticated technology to build new kinds of financial offerings that blend savings, credit, and insurance in ways that map to customer needs rather than to traditional product categories. To create those offerings, Kaleidofin partners with regulated banks and insurers on the back end that bring the licenses, the compliance, the balance sheet, and Kaleidofin then uses those components to build its offerings. For distribution and customer relationships, Kaleidofin partners with microfinance institutions and other financial service providers that bring the clients, the branches, the field staff through which products are marketed, sold, and serviced. Now, Kaleidofin could, of course, apply for its own licenses. They could build their own distribution networks and customer relationships, but that would take a lot of time and resources. And even then, it's not clear that Kaleidofin has a comparative advantage in any of those layers. So why spend all the time, money, effort building something where you don't necessarily have an advantage? The far better route to scale and profitability is to partner with players who already have those things, because chances are they are better at it. And more importantly, they have already invested the resources to build them. So the marginal cost of allowing Kaleidofin to leverage on them is very low. For M-Pesa, it's in some ways the same story, but from the other end. So M-Pesa is the first and most successful mobile money operator. They've revolutionized access to accounts across Africa. And M-Pesa has enormous assets in the customer relationship and distribution layers as a result. They have over 50 million customers across 7 markets. They have a distribution network of millions of agents and merchants. And while they built the initial payments products in-house, as they've expanded into other financial products, they now offer lending, remittances, insurance, savings, and so forth in various countries. For the most part, those have been built in partnership with third-party banks, fintechs, and insurance companies. If you'd asked me 10 years ago, I would have been dead certain that M-Pesa would have a banking license by now. But the fact is they don't, and neither does almost any mobile money provider anywhere. They are all moving deeper into financial services, and M-Pesa more so than most. But they're doing so by building products in partnership with existing fintechs and financial service providers, not by trying to do it all by themselves. M-Pesa, in fact, is even going a step further by adopting a marketplace approach. They've designed a simple way for banks to plug in to M-Pesa and build products for M-Pesa users based on M-Pesa data, which lets M-Pesa substantially increase the range of financial services that people can access on their platform, but without worrying about the banking license, the balance sheet, the compliance, or even the product design of those products. Grab is in many ways a similar story, though it's a very different company. Grab is one of the most successful super apps across emerging markets, the biggest in Southeast Asia. They started in ride-hailing, but fairly quickly expanded into delivery of food, groceries, and packages, and from there have grown the scope into a range of domains, not least of which is financial services. Grab also has huge assets in the customer relationship and distribution layers. They have over 27 million customers across 8 markets, several million drivers and merchants. Like M-Pesa, Grab started with payments, but has moved much more deeply into financial services to the point where it offers a range of lending and insurance products to the different users on its platform. And in building those products, it was largely also partnered with fintechs, banks, and insurance companies. Grab is, however, distinct from M-Pesa in one key way, and that's that they have recently acquired banking licenses in 2 of their 8 markets. So I'll be very keen to hear any reflections on how they plan to use those and how they see the distinction between having your own license versus partnering for that. Meanwhile, DaviPlata, our 4th company on today, offers yet another example with a slightly different twist. DaviPlata is a business unit of one of Colombia's largest banks, Banco Davivienda. And it was launched as a mobile wallet aiming to scale up the reach of the bank into underbanked segments. It operates within the bank, but is managed as a standalone business. They have their own CEO who is with us here today. So DaviPlata builds its own product, acquires its own customers, but the bank provides the regulated layer and the distribution layer through banking agents. But DaviPlata also powers the payment wallet for Rappi. Rappi is the equivalent of Grab in Latin America. It's the biggest delivery platform and super app. It was founded in Colombia and they needed a payments wallet, so they partnered with DaviPlata. So in that partnership, DaviPlata provides the product, Rappi brings the customer distribution layers, and everything is still anchored in Davivienda Bank at the top. So here are 4 really different companies that all illustrate this shift toward a more modular or layered or stratified market for financial services. Now, this is obviously stylized and highly simplified view to look at these companies. I'm sure there are any number of objections you could make to the way I've described them just now, but we think this is a useful way to think about how financial services are changing at this moment, because we're seeing the same thing develop in a range of different contexts. Some version of platforms that bring a large customer base and distribution network, fintechs that build innovative products and experiences, banks that provide regulatory space, balance sheet compliance, and so forth, and that all then partner across layers to build the value chain for financial services together instead of trying to do everything by themselves. In other words, banking in layers. Now, this is all very abstract. What does any of this actually mean in practice? What does it have to do with financial inclusion? I'm going to close with a few reflections on that point. The first of which is through a short video that we made to speak to that very question.
Technology is changing banking at every level, potentially transforming how low-income people and businesses engage with the financial system. Like Farida. Farida runs a small clothing business in Jakarta, Indonesia. She uses a social media app to market her products. She also has a mobile money account that she uses to receive payments, pay suppliers, and buy airtime. However, she can't get a loan to expand her business or sign up for a savings account to pay for her daughter's schooling. Many financial services are just too expensive and hard to access. Farida's situation isn't unique. Hundreds of millions of people worldwide live with similar circumstances every day. That may be about to change. Historically, even people with a bank account tended to only use a single provider that offered them a limited menu of its own products. Thanks to new technologies, there has been an explosion in fintechs that specialize in offering better versions of many services. As a result, people can choose from a range of providers and assemble a suite of products to meet their needs. This unbundling of financial services is putting the custom back in customer. But new technology isn't just giving people more options, it's also changing how financial services are made. Banks used to do everything themselves. Today, they can stitch together the best solutions from an array of fintechs that are focused on solving a specific problem better than anybody else. And it isn't just banks. Fintech solutions can be embedded into any company and reassembled to meet the needs of its customers. Thanks to all these advances, Farida can buy more fabric with working capital from a fintech. She can also save for her daughter's education with the savings account she obtained through her mobile wallet. The payments and delivery services embedded in her social media app can help her grow sales. And she can upgrade her sewing machine with asset financing secured against her digital income. These advances create new risks that need to be managed by regulators, businesses, and consumers alike. But they can also result in banking that offers lower costs, greater access, better products, and improved experiences for customers, including low-income customers. Whether these benefits are realized will depend on the choices made by businesses and regulators. To learn more and stay informed, visit cgap.org/fintech.
So as you heard, we think this unbundling can help advance financial inclusion in 4 key dimensions. It can help to cut costs through cheaper customer acquisition, distribution, risk assessment. It can expand access through greater eligibility, affordability, and a shorter distance between client and product, both physically and digitally. It can help improve product fit with products that are more directly relevant to the context in which they're being offered, more tailored to different users, and better experiences through simpler and smarter products that are easier to understand and to use. And this is not just theoretical. We wanted to understand how customers themselves experience these models. So we've just completed research with nearly 1,500 customers across 5 countries, including interviews with over 1,000 customers of Grab and Kaleidofin. And our findings are pretty compelling. More than half of customers say that this is their first access to the kind of financial services that they are accessing through these companies. More than half say that their ability to manage their finances has improved thanks to the services. And 3 out of 4 say their quality of life has increased as a result of that. We're going to have a session next week that goes deeper into these data. So if you're interested in more about that, please join for that. But with that, I'm going to end my intro. I know I've tried to summarize a very complex thing in a short amount of time. So if you want to know more, head to cgap.org/fintech. You'll find lots more materials on all this there. But now let's hand it back over to Xavier and to our amazing panel of industry leaders to unpack what all this looks like in practice and where things are headed.
Thank you, Peter. I think you summarized a very large topic into a few slides, and probably some of us are still trying to digest everything you said and the implications of what you said. But I think that the most important aspect that remains after this presentation is this change in the structure of the market and the different roles that different providers play based on their natural abilities and assets. Let me start by posing a question to the panelists. And in most cases, the place you are today results from a journey that you started from a different business, either a bank that started moving into mobile banking, or a platform that was doing something else and started going into financial services. Can you tell us a little bit about how you started that journey, or that journey leading to the present role you play in this structure of the market, in this stack that Peter was just describing? So maybe we start with Philip.
Sure, Javier. So first of all, thank you for having me in the panel today. And Peter, that was a wonderful encapsulation of what's out there. And in a lot of ways, I feel that what you described, we're living every day in Grab. We do literally see and feel the layers that you're talking about. So I'll touch on that in a second before I end. But in terms of our journey, it's relatively simple. We are out there solving everyday problems for our customers in Southeast Asia. We started in transport, and from there we went on to delivery, because once you have that army of people that could drive people from point A to point B, what else could they do? They could deliver packages. And so we added delivery of packages. And beyond that, what else do you do? So to make the whole experience easier, you add payments rail to it. And when you do that, you have a payment service that got created from there. And when you have payment service and you have people that can move molecules from one point to another point, what else could you do? Well, people want food, then you do food delivery. So it's very much a layering on and having the North Star of making things easier for our customers. That's where we really ended up where we are. I think we took a somewhat different path than others, but I think the endpoints are kind of the same, where unlike say 10, 15 years ago, right now, customer is king or queen, as it may be. We have to wrap our services around them. Super important for us and for our customers. Going back to the layers, I just want to make one point that may explain some of the differences between how different companies have developed. So the layers are wonderful, but what is also important that we live through is that there's a need for a fabric that connects these layers. The fabric can actually stop the creation of the layers. So a bank may say that this particular service is wonderful for me to jack in and replace. The problem is they don't have the data information layer to be able to easily integrate. The difficulty of integration gets so hard that they just don't do it. Banks that you go and you say, hey, I know these customers really love product A, but the banks say profitability on that is not good. It's our experience. We don't want to do that. Can you what if I manufactured B for you instead, but B doesn't fit our customers? So there is a natural tension that happens, and it depends, I think, in the part of the world that you're in, the competitive landscape that is between the existing banks, whether they are there conducive enough to work with the fintech companies or whether they are not. So you'll see many different mushrooms, different versions, which is why Grab has actually become a little bit of a counterexample to what you're talking about in terms of the layers. We actually had to go back to the basics of building a more integrated service because just frankly, in Singapore, there are 3 incumbents that are super strong. They deserve the success that they have created, and they are an important part of the Singaporean economy. But in terms of servicing all sectors of the economy out here in Singapore, we're highly banked, but we're not exactly highly served, especially for small and medium-sized enterprises. So, there is always room for disruption, and banking is ripe for disruption, in our case.
Thank you, Philip. There were several things you mentioned. The focus on the customer leads to incremental growth. You keep adding and expanding to different layers based on maximizing value to the customer. I think that's what I understood. And I think that leads to choices that might not have been natural for a traditional provider who is looking to maximize profit. Although these two things are not different, right? The more you serve the customer, you also can make the case that you're also improving value to the firm. But I think that's a bigger conversation. Let's go with Margarita. Can you tell us a little bit about the journey from DaviPlata from Davivienda, the Banco Davivienda, going into DaviPlata and expanding beyond that?
Good morning. Thank you, Xavier, for this invitation. And yes, DaviPlata has had a decade of history in Colombia. From the beginning, it positioned itself as a financial solution through the cell phones in a country where more than 40% of population was excluded from the financial sector. And this is how, through feature phones and strategic allies with mobile operators and other important actors, we launched a disrupt solution on the market, a mobile wallet that allows money management. And we also offer different functionalities to be carried out, becoming a tool that is a part of the daily life of the Colombian banks. And DaviPlata began to explore other business models where through the bank as a channel, for example, and it offers third-party financial and non-financial products to its clients in our platform. And we have a use case that is our marketplace that we call a virtual store in DaviPlata, tienda virtual, and where our clients find a complete financial offer with insurance, credits for other entities at added values or non-financial service, social booking, entertainment, health, mobility, assistance. It's a different services and products in our market, our marketplace. And seeking to be a leader in innovation, DaviPlata seeks to be where our clients are. This strategy, it's leverage of the banking as a service strategy, reaching business or important platforms where there is a critical mass of client as well. As a financial ally, offer an easy experience to pay, manage of their money. And this is done through AP or connection that can be simple or more compressive. And the most compressive is the financial license to open DaviPlata and manage the money with the Rappi and with the CGAP Pay in Medellin. We have two allies, one with Rappi, that is an unicorn from delivery, and the other strategic ally, it's with a Metro de Medellin. Metro, it's a subway, it's in Medellin. It's one of only city in Colombia that has a subway. And we have an ally with the public company in our country, and to build a new offer for the citizens and now the Medellin citizens it's possible to pay the subway with a QR and have other functionalities to enjoy the city. And this is a different ways and can I explore to have the new stack, the new models in DaviPlata.
Yeah, Margarita, Philip was mentioning earlier how it was natural for Grab to move from delivery app into incorporating financial services. Can you tell us, for the bank, being a bank and being an important bank, Davivienda in Colombia, what was the rationale for starting a completely different business around launching a mobile wallet, and how did it make sense for the bank?
Because it's really the important feature is to be where the client need, and Rappi has a lot of clients and with a good experience for delivery, and they need licenses to has a mobile wallet. And it's we think that, okay, you have a clients and a good experience and other business, and we have our licenses, we have the APIs, and we have the other experience in the simplified accounts, for example. And we have an ally to offer than clients the two worlds, and it's a good ally. And now Rappi be a bank, and now maybe in a few months there are our competitor. Yeah. Okay. But it doesn't matter. But it's the way. But I think
sorry. Yes. Yeah, no. I get it. So two things that you said I think connect well to the conversation. One is the bank saw the need to connect more closer to the customer and meet the customer where the customer was, instead of expecting the customer to land on its branches, needed to go out, right? The other thing you said that I think connects well to the conversation is the opportunity to create the modules that others needed to bring financial services in what they were doing, which was, and the bank was seeing that as an opportunity, so it went out of its way to do that. Great, thank you, Margarita. Let's go with Laura. Laura, can you tell us a little bit about M-Pesa's journey into this more diversified structure?
Yeah, absolutely. And thank you everyone for the invitation to speak today. So last year, M-Pesa dispersed processed and dispersed through our platform at 4.2 billion value of loans. But we're still, and so that's a really good base to work from, but we're still in a big kind of seismic shift at the moment to move away from much of the models that have underpinned that, super successful access to finance to a new way of banking that Peter kind of outlined earlier. And at the heart of that really is around data. So previously, it's a very traditional partnership model where we've provided that data to the bank. And instead, now we're moving to a model where instead of that, we've worked to develop a bespoke M-Pesa credit score that's provided, as well as a rules engine that we provide out to the partner banks that can process real time, well over kind of 50 rules and growing, that really enables us to do a number of things with that engine. So we can do risk-based pricing, risk-based credit limits, a lot more segmentation, loyalty-based products. And what it does also by having this platform is really give us a much better view of the customer. So rather than having siloed products, we have all banks plugging into one, where we have this one view of the customer to support in trying to prevent over-indebtedness. And lastly, and especially in theory, because we're new in this journey, is it should provide a much kind of level playing field for all banks to plug in, rather than this just one option of a partnership. So we really wanted to make this journey for commercial reasons, for financial inclusion reasons as well, which we can go on to. And we're really hoping part of doing this, that we can really work to push the value of the loans up that we see across that portfolio. The loans that we've processed are still pretty low value loans, very much sitting within that cash flow smoothing type portfolio, and we really want to be able to support more of what Peter had in his video, whereas really supporting kind of those productive assets that are critical for economic development.
Excellent, thank you, Laura. Just to put the spotlight on something you said that resonated a lot. So the transition to platform that produces a score, a rules-based engine, more data to facilitate segmentation. The vision there is that it can lead to a much more diversified and tailored set of products that others produce and provide. And it also leads to something that others can plug and play. So you're developing it as a technology that enables easy plug and play that can kick off an expansion of the market, because more providers can do more through that. So I think that's a very interesting vision, and it resonates, it aligns well with what we were describing earlier. Thank you, Laura. Puneet, your perspective.
So thank you so much for inviting us to this event today. Really glad to be here. Quick background, we work in India. We work largely with informal sector customers. The focus for Kaleidofin is to reach out to the last 700 million customers in India who are currently not digitally enabled. And the moment you start by, when I start by making the statement that we are trying to work with customers who are not digitally enabled, my next statement is that we are a fintech company, and this just doesn't sit together extremely well. That how do you reach out to these customers if today they're not using smartphones? Less than 30% of our customers today own a smartphone, and less than 7% of our customers have ever made a digital transaction in the first place. And as we started to kind of look at this problem, we also started to recognize that the solution, if we were to take financial solutions to these customers, was not to build out a physical infrastructure. They may not have a smartphone today, but their next change of phone is going to be a smartphone. And the moment you put this together, I think it did not leave us with too many options. What we started to do was we started to think about that the challenge for us is not to reach out to the next 1 million customers, but the challenge is to reach out to the next 700 million customers. And as we started to put it together, we realized there were many, many entities who already had a physical outreach to customers. So the bottom layers that Peter had kind of presented, that are we actually adding value to getting newer customers? The answer was no. Also, the moment you start to work with customers who are not digitally active, the cost of acquisition of doing this in an assisted mode is extremely high. The partners that we started to work with, these are partners who were already servicing these customers, had an entire staff base which was reaching out to these customers, meeting them on a day-on-day basis. And what it meant was, if there was a way for us to partner, we actually start acquiring customers at cost tending towards zero. We just had to find the right partnerships to make sure that our partners got the benefit of bringing customers to us. On the other side, India is very different from many developing markets. We have one of the strongest capital markets. We have strong banks, strong insurance companies, which already had a massive footprint. And we started to look at this, that their focus is just not the 700 million customers. We first started by saying, can we just become distributors of their products? And in this entire process, we start to put the chain together. And as we start to do this, we realized that the products that were being offered to the customers were so alien to the customers that it made no sense for them to work with this entire sector. For a lot of our customers, even if they understand the concept of something called insurance, the moment you start to talk about accidental insurance, hospital covers, health insurance, asset insurance, just the entire segmentation of insurance products itself was so many different labels, and each one of these labels requires a significant understanding of this and presents a lot of cognitive load to our customers. So what we started to do, like some of the other panelists talk about, we started to find a way in which we can use the power of technology and data sciences to create customer personas, try to combine these products into creating a new solution for the customer, which was extremely intuitive. In the process, rather than offering to a customer a product by product, we were actually offering 5 products together, which when offered as a bundle, started to make a lot of sense to the customers, made it very intuitive, made us delete all the fine print that was possible, but at the same time also added to the economics of the core product itself. And in doing this, we realized that the sweet spot that we were able to bring to the table was this entire layer of product design. And by working on this product design element and by stitching together a very strong technology which connects everything else, we were able to make the entire chain work. And that's basically by just kind of making that entire, the work on only one narrow segment, we were able to actually unlock all the capital that was already invested in this ecosystem and a small amount of money that we have raised. We've raised less than $25 million through 4 years of our work, but that has already allowed us to create $1 billion worth of assets in credit in a newer asset class which didn't exist in India before. And it is an asset class which is increasing at an increasing rate as we speak. So that's largely how we've kind of got to our place in this entire hierarchy of layers.
Thank you, Puneet. I think you among the things you said, you highlighted something that has to do with an important change in the dynamics of the market when the market transitions to this layer structure. Specifically, you said because there's a lot of companies that are already reaching the customers that we want to reach, we don't need to invest in customer acquisition. We just layer our services on their relationships. And essentially for us, it means customer acquisition cost is zero. And because it's zero, then you can focus your efforts in producing bundles that make sense to the customer. And that is different because in an environment where customer acquisition is high, you can't just freely focus on what does the customer need. You focus on what is viable, right? Because you already have a cost upfront, so you can only offer so many things that can make it viable, and that ends up mostly being credit, right? Credit is the one that pays for everything. But if you bring it down to zero, then you have the freedom to create a more diversified set of product and focus on maximizing the value proposition to customers. So yeah, great. No, that makes a lot of sense. So thank you for that. Let me move on to the second question we had, which has to do, it's a little bit more complicated from the sense that if you look at these layers, the one layer that is directly related at the front end to the customer seems to play an outsized role in orchestrating the rest. So if you have a wallet and you have the relationship with the customer as a provider of the wallet, then you get to decide what else shows up in your app, and you get to discriminate. And there's positive things about it because you can bring a lot of things that are good for the customer, but you also get to decide and filter out and say, no, I won't bring this, or across all these providers, I'll just pick that one. So the question is, what are the positives and the pluses and the minuses, the positives and negatives of this? What kind of dynamic does that lead? Is that something we should be worrying about as an issue in this structure? Or is that actually a positive thing, that there is one player that actually orchestrates and tries to make things work out the best for the customer? What are your views on this? Let me open it up and see who wants to respond first.
I'm
happy. Go ahead, Laura.
Let's start with you, Laura.
Yeah, as I was gonna say, I mean, I think that the entity that works closest with the customer likely does have the kind of, I guess, in some ways, more of that power dynamic, right, across the partnerships. But I would say that that's a lot down to, at least in our case, the data that you get from having that last kind of touch point with the customer and the insight that you then have around what the customer needs and wants and can do. I'd say also that, all partnerships have power dynamics as well. And so that's true before we in kind of our legacy stacks and very much as we move to the technology stack too. So we're quite conscious of that in kind of bringing the proposition together. But I think what is interesting in credit, and as you said, credit's kind of the king, I guess, in terms of the profitability piece for many of these partnerships, is even within a traditional bank, let's say, you get this tension between, and I kind of get witness to it almost as the third party selling a solution, between your risk governance teams and your sales teams. So that's even within one organization, between the sales team that want to, or innovation team that want to spread out to the most amount of customers, and your risk and governance team that's obviously protecting the profitability. And it really is just all about that trade-off curve in terms of how many people you can access until your delinquency rates change. And so that's at the crux of all of these models. And in the way we've described and what we're doing is actually we're providing the tools to kind of manage that trade-off to the bank. So we're being more involved in that, let's say, potential disagreement between the parties rather than the bank internally just having kind of that friction. And so we've got to provide tools to make sure that we do that to the best effect in order to roll out to the most amount of people, because obviously that's, our number one aim also. So I think to kind of answer your question, there's still a lot of leverage that our partners have, because ultimately they own the risk, and ultimately they have to be confident with these models in order to get to that sweet spot on that trade-off curve. And so, we very much have to kind of work around that in order to get where we want to be.
Laura, thank you. And Puneet, we'll go to you in a minute, but let me just highlight a couple of things. So yes, there is a role at the front end around being close to the customer that generates data and insights. And from your perspective, you're focusing on tools to enable others to do a better job serving the customer. But you also said, there are profits to be generated across these different layers, but there is also risk that is allocated. And when we think about enabling the whole stack, it's important to understand that dynamic between the risk, who takes on the risk, and who makes a profit. And there are some tensions that evolve within players and across players. Okay, so let me leave it at that because it's an interesting perspective. Puneet, can you share your views?
Yes. So actually, I was going to say part of the stuff that Laura already kind of pointed out. I'm in fact going to highlight a little bit of a challenge as well. It's not all sleek and rosy when you kind of look at layers, because in many places, including in India, where open banking is not necessarily out there, and we basically are trying to work as if there is open banking available. The person who holds the license holds a very, very strong and a dominant position in this entire spectrum of things. And therefore, sometimes revenues don't necessarily move in terms or do not get split in terms of the value that is added by different partners, but the scarcity value of the license starts to get people to corner a large part of the value. The second challenge that we typically find is that when you look at investors who are evaluating us as fintechs, there is a very, very strong view that consumer-led businesses, and there is something in the mind, which is to say that if you own the customer, you actually own the largest piece of the pie, and entities who have a direct touch with the customer are valued disproportionately higher than entities who are not necessarily reaching out to the customer. And if you look at entities like us, who therefore sit in the middle, where we don't have a license, we don't have a customer touch point, it starts to create a very different kind of a tension on saying that how do you actually start to make some of this work. The way we've actually gone about doing some of this work has been to say that the value that we are able to bring in terms of ownership of data that flows through this particular system, and the way we've been able to use data to be able to create different kinds of products is not an easy IP for most people to build. And it's not easy for entities to be able to cut us out from the picture and continue to do the same things. So there's a lot of what we have tried to do is to do that. But having said that, we've done enough to make sure that the IP is not a black box whereby different participants don't trust what we've built in the layer here. So it's a little bit of a delicate walk. And I would say that what we are trying to do, we are at the very beginning of this long journey. And I believe that as we move forward, a lot more open banking is going to happen, and a lot more there will be a lot more acceptance of entities in different layers, and that will actually make things much easier than what they are today.
Thank you. I think one of the things that stuck out to me based on what you said is that you can identify in each layer, you can identify things that are pretty unique to that layer that may sit in an important, so it's not necessarily that one has outsized power with regard to the others, because everybody has something that is important to the puzzle. One might have the license, the other one might have the customer relationship, the other one might have the physical distribution, the other one might have the IP in product development, and all of these are unique assets. Thank you. Philip, what are your views around these power dynamics across the layers, and who actually holds more power over the others?
Yeah. So I'm almost jumping out of my seat to join in to this discussion. I want to just share very frankly, right? The one who holds a customer relationship is the orchestrator, and the orchestrator inevitably has outsized influence. I think what we have learned in the last 2 decades of the computing revolution that we're on at the moment is there is power of social. If you're able to orchestrate people, you can do many, many things for good or for bad. So I think that the fear is there, right? I do agree, Javier, that if you have outsized influence that way, it may not be good, but it could also turn out to be really good. It depends. And I think it depends on competitive forces. if you have this ability to orchestrate, and you orchestrate in a way that doesn't serve your community. You go through the different layers, you put together products for your customers, and it's actually economically pretty good. But over time, customers discover that it's a bum deal. Guess what happens? The community doesn't follow the orchestrator anymore, especially if there are competitive forces that have others who are trying to orchestrate. So I think that points to how I think ecosystem players like Grab keeps ourselves honest, because we know that there are other ecosystem players also. You can look through the press and see who our competitors are in Southeast Asia. There are plenty of them. So I think in a very good way, the giants who are doing this, who are the orchestrators, if we have the capital, we will go back and get licenses, and we will build as much as we need to in between. And we might even aspire to have a walled garden at some point in some particular products, because we have the capital to do so. But at the end of the day, if we don't serve our customers well, we know customers will walk away from us. So I think that is a very strong gravity that keeps us very, very honest. So it is a well-founded fear, but I hope governments continue to promote competition. And as long as we have competition, free movement of ideas, I think we're relatively safe, because the people will walk away from these folks.
Yes, I think you bring up a very, very important point, right? The player at the front end can decide to go the walled garden way, and build a private ecosystem, but then they risk against competition, losing against the competition, right? So that keeps forces aiming more towards a more diversified, a more ecosystem kind of approach, which ultimately benefits the customer. So it's a tough dynamic. Margarita, any brief views before we go on to the last question?
Yes, I agree with Philip and Laura and Kaleidofin, and it's before defining who owns the domain, the important thing is to be clear that the end user or our client must always be at a center of the strategic relationship. In case of Rappi or Civica, in our case, is two apps. It's the front end of the user, yeah, and DaviPlata and the bank is in the back, yeah, with a specific experience for a banking, yes, but the front end, it's the other apps. And really, only I want to aggregate that it's the different super apps for a lifestyle, and we are okay from the bank. We want to contribute to consolidate for other important players and us, but definitely the relationship where both parties through with a win-win relationship, and how to offer more than better services to customers. It's an important, yeah. We need to build a win-to-win relationships, and it's who is the domain. It's not clear in the line. It's very brief.
Yeah, no, it makes a lot of sense, and it's aligned with what everybody has said. Ultimately, the value for the whole ecosystem has to do with maximizing value to the customer, and if everybody wins if we're able to achieve something like that. Of course, the reality is that these tensions are sometimes not easy to resolve. But let me ask Peter. You've been looking at the chat. Is there any particular question that we should pose? We might have 2 or 3 minutes for one question from the chat.
No, we've been answering questions in the chat as we've been going along, and there was no one that sort of jumped out at me specifically. So I think that's fine. I might ask a follow-up of my own to Philip, just to unpack a little bit this decision of yours to get the banking license, because I think that's interesting, and it goes to the heart what we're talking about here. You already spoke to some of that, but my sense was that Grab would prefer to stay out of that layer and to partner, but that there are frictions in the market around integration with partners and around having the same vision for the consumer and being prepared to offer what the consumer wants. And that made it hard for you to find partners that were flexible enough to give you what you wanted, essentially. And that's kind of forcing you into those layers. So love to hear whether that's correct and how do you see those trade-offs, and depending on kind of the market context. So how does that market context shape how the stack plays out in other words?
So I think what I can share is if events had unfolded differently the last couple of years, we may not look like what we look like today. That's frankly the way it is. We started in Kuala Lumpur in Malaysia. We eventually have our HQ in Singapore, and Singapore was our natural spot where we would basically have it as our ideas lab. We make it work over here. We spread it through the different operating countries that we have. And for financial services, it just so happens that in Singapore, regulators have been trying to get the three dominant banks to digitize themselves and serve all segments of the economy in Singapore since the 80s, into the 90s, into the 2000s, and into the 2010s, and into the 2020s. And they have succeeded in some degree in some places. Some experiments have created stillborns, and some did create something that was better. But it wasn't at a point where the government felt that it was successful. And so what did they do? The MAS, the Monetary Authority of Singapore, being the pragmatic group that they are, they said, why don't we unleash competition upon this problem? And so they said, hey, we can have full digital retail banking licenses in Singapore. You have to prove that you are going to be a good actor, but we will grant you that license in competition with the others who are on the island. And that's a really, really good way to, I think, get the competitive juices going. And we on our side in Grab, we thought that it was a fantastic opportunity to solve a really, really big problem for our customers, because we could see that the banking products that they were getting were the banking products that the banks wanted to sell to them. And we were thinking, what if we made it totally customer-centric? Let's focus on making it revolve around them, making it easier for them. If it's convenient, why don't you make it convenient? And if we can understand customers better, and we can provide credit at higher resolution, where we can give credit where others cannot tread right now, why not do so? And so we thought we were up to the challenge, and we found another great ecosystem play in Singapore, Singtel, Singapore Telecom. And between Singapore Telecom and Grab, we basically have everyone on the island within our ecosystems. So we think we can do a pretty good job. And so we sort of stumbled into it because we were still on that let's solve the customer problem direction. And what I could express to you earlier, half an hour ago, is maybe a little bit of looking backwards and making sense out of it. But the reality was that when we were living our adventure going forward, we didn't have all these plans all in front of us. Right now, looking back, we could tell it a little bit cleaner.
Thank you, Philip, and thank you, Peter, as well. So we are on the hour. We had more questions, but I think we don't have time for those now. But I'd like just to take a minute to say thank you for our wonderful panelists for being so open and sharing your thoughts and so frank. There's a lot more to talk about, but at this point, we really appreciate your time and your contribution. And we hope there's more opportunities to keep this conversation going. Thank you, and also thank you to the audience. If there's more interest, there's cgap.org/fintech, where we consolidated a lot of the work that we've been doing on these topics. Thanks again. Thank you, everyone.
Thank you so much. Bye-bye.
Thank you.